Good afternoon, everybody. Brian Cochran here, financial planner with John Moore & Associates, calling in from our office here in Albuquerque. And beside me is John Moore. We're excited to be here with you this afternoon and to follow up with this presentation for the quarter. This is part of our quarterly webinar series of market updates that we continue to bring about every 3 months to you. And great content this quarter. Obviously, a lot of issues going on in the markets and the economy and politics, so we have plenty to talk about as always. So as participants, you are all on muted lines. We just want to remind you, if you have any questions, feel free to go into that control panel you should be seeing on the right side of your screen. And feel free to punch in some questions. We will save those till the end so we can get through our prepared comments and all of the slides. And then if there are any questions that you want to ask while we're live here, we'd be happy to go into those questions at the end of the webinar. And of course, as always, feel free to give us a call or an email after today's presentation if you have further questions or things more personal in nature. So several topics to discuss today. We're going to start off by talking about some trends in the markets. We have weekly investment committee and we get research from that we'd like to share with you. We also have a review of our economic indicators. We want to look at valuations, and there's a lot of talk about, are stocks overvalued? Are we in a bubble? That seems to be an ongoing conversation. We will address that. We'll also be talking about interest rates and the Federal Reserve, and we'll close with a discussion of the elections and key dates coming up as we wrap up to the end of the year. So we'll get through all these topics, and again, please feel free to punch in questions as we go through content, and we will come back to slides and cover those questions at the end.
Well, this is John, and again, good afternoon to everyone. Just a couple of comments about how things are going with the company. We recently extended the lease at our Arizona office, and we're very pleased with that location. If those of you who are in the Arizona area, we'd love to have you stop by, or if you're visiting over there, we'd also love to have you stop by and visit our location. We are very proud to announce that JMA has been nominated for the New Mexico Ethics and Business Award. That's awarded through the Anderson School at University of New Mexico, and we were recently interviewed by a student committee as part of that competition. There were 4 companies nominated, and we will find out the answer in January. And whether we win or not, it's a great privilege for us and a real honor for our team to be included in that list. I did want to mention a couple of things with our team. We introduced you to Greg Hartenbauer last quarter. Greg has settled into the Arizona office and continues to deliver outstanding service, and we're very welcoming to him being part of our team. And then Andrew Donahue, part of our G3 contingent, recently successfully completed the Accredited Asset Management Specialist certification, and that training continues to improve his knowledge and skills in the industry. And he also just got back from the Raymond James home office. The folks at Raymond James are helping us put Andrew through an 18-month training program as we grow him up into being a terrific financial advisor. Erica had her baby back in May. She's back at the office here in New Mexico, and we're glad that she's back. Baby and mom are both doing great. The market history, you know, before we go into that, I did want to mention that we had questions about Britt Short, and Britt had her baby in August, and Britt has made a decision to not return to work at the office. And we'll miss her. She's been a great contributor, and she and Hadley, her daughter, are doing great. And Randy, I think they're short a little bit of sleep, but that's part of dealing with newborns, right? So historically, we like to take a minute and look backwards and see how the markets are doing, and kind of across the spectrum of various indexes. And at the end of the quarter, on September 30th, the S&P was up almost 8%. Small cap stocks, as depicted by the Russell 2000, about 11.5. Notice that EAFE, now that stands for Europe, Australasia, and the Far East. When you break down that index, it's essentially 2/3 Europe and 1/3 Japan. So it's non-U.S. stocks in developed countries, and it is lagging. And notice how it's lagging in every time period. And we do feel at some point there will be some catch-up possibilities, and there may be some opportunities in Europe. And we have, in one of our models, we actually have a position designed to take advantage of that potential catch-up. The other kind of surprise this year is the Barclays U.S. Ag. That's a bond index, and even though interest rates are low, that index has had a very decent year, up 5.8%. I would also add, since October started, all of these indices are up 2%, or excuse me, are down between 2 and 3.5%, and so that we don't know how October is going to end, but but it has been kind of a volatile, rough month. We think some of that's tied to the election, so time will tell. From a trend point of view, we've used this slide multiple times, but I would like to cover it again because we think it's a significant thing. And we have a saying in the industry that the trend is your friend, so we spend a lot of time studying trends. And that period from 1975 over here on the left to the end of 1994, depicted by this yellow set of data points, is a 20-year period that we just declared normal. And normal does not mean no volatility. The crash of 1987 is right in here. That was a 22% down day. But then we asked the computer, tell us how the market did over that 20-year period. And this yellow extension is the trend. That trend is 8.1% per year. At the end of the 90s, we got ahead of trend. We had Y2K, 9/11, Enron, and WorldCom fell below trend. And as we approached 2008, we actually thought we might be about to go back to trend, and instead we entered the financial crisis period and fell out of bed. And in the summer of 2009, excuse me, in the spring of 2009, our consultant Virgil Dugan came and said it is now mathematically impossible to return to the trend of the yellow line, and that we should plan a reset. So in the summer of 2009, after the Lehman Brothers dust settled, we plotted a reset point. And the most important thing Virgil said that day is don't change the 8.1. That trend is the correct trend. And so this magenta colored line represents an 8.1 trend, and it's bolded starting at the reset point. And what you'll notice is we were running ahead of trend for several years, really, and we think that's primarily due to the quantitative easing that the Federal Reserve put in place. And then what we had been hoping for, we ended up getting. We had been hoping for a sideways correction back to trend. We did not want to go through one of these sharp, steep declines, and we got that. And as of July, we kind of got back to trend line. And we look at this a little bit in more detail here. The market spent that sideways period of about 18 months in a significant trading range, and in the third week of July, it broke out to the upside. One of the things that is very encouraging to us is this test where basically we rallied and then we went back and tested that what is called a support level, and we've since bounced back somewhat through the end of September. And again, this is very positive market action. When you have a breakout like this, it tends to have bring potential good news, and we'll continue to monitor it, but a breakout to the upside is a significant positive event. Brian?
So a lot of folks have been asking us, how is the market up with all this uncertainty, with the election, things like Brexit? And actually that breakout that John just mentioned actually happened almost about a week after Brexit is when that really started to go into a strong uptrend. So how could that be possible with the world under so much uncertainty? And one of the ways we answer that question is we always look at big picture economic indicators. And we shared this last quarter, but for those of you who weren't on that call, one thing we look at every week in our investment committee is we take a broad look at various U.S. economic indicators and what do they tell us about the state of the economy. And if you look on the left side, as you can see a list of these indicators, some of these report every week, some every month, some every quarter, but each time we get a new number, we take a look and we say, was that newest release of data, did that meet the expectations of the market? Was that above expectations or was that below expectations? Keep in mind, the market very much trades on expectations. So when we look at this, we give it a rating. And if you look on the far right of this chart, you will see our scoring convention where we award a number 3 if the release of whatever data comes out meets expectations. We'll provide a number 1 rating if it falls way below expectations, and a number 5 if it exceeds expectations. So we end up with we're shooting for numbers of 3 or higher here, just so that the economy is on the right track and meeting the expectations of economists and analysts. And when you look at the net result or the average result of those numbers, we end up with this mean down here, this column that you can see some of these green squares. A green number shows that it is meaningfully higher than expectations. So a 3 here would mean that on the average we're beating expectations. A 3.2, a 3.5 shows that we're, on the whole, we're exceeding expectations on economic data. And what we saw here, this chart doesn't go this far back, but we saw a big turnaround here about the time of that breakout. So just after the Brexit, despite that negativity and that volatility in the markets, economic data in the U.S. started coming out and meeting or exceeding expectations on a very consistent week-by-week basis. And we think that fundamental improvement in economic data was part of what pushed the market upward and through that breakout that John just shared on the previous slide. So again, despite all the headwinds that you might think are out there with uncertainty and election and all the negativity, overall the economy appears to be on really steady footing. And that good economic data tends to show up in GDP and then show up in earnings and drive stock prices. So we think that's a big part of why prices have been going up throughout the second half of the year especially. Okay. Again, very counter to what you might get if you just watch the news and the sense you get. This is why we come and look at this, so we get a better sense of what the real numbers are showing us. Another way to see the same story is to look at this chart. That mean number we saw that was getting in the green, see this 3 we have on this chart, and this blue line shows kind of the trend. Again, for a while we've been trading below that 3 range, or we've been reporting below that 3 range, saying that again we were below expectations for a few months when it came to economic data. And then as we got into the middle part of the year, we started to get better and better and exceed that number. We're still in positive territory. So again, showing that we're meeting or exceeding expectations. The second half of this chart, the red line, shows that there was a decrease in uncertainty. What that really means to us is that there's more and more consensus amongst economists and analysts as to what these numbers should be. So when we talk about expectations, how broad are those expectations? They're getting more and more concise. This is all very positive in our view, and again, the important thing here is it may be counter to what you're hearing from friends, neighbors, and the media, but that's why it's important that we look at this.
We like to spend a lot of time just looking at facts, and we understand the emotional things that are out there. We hear them, we read them. Many of you have sent us things to read. We take them very seriously, but in order for us to keep emotion out of the process, these facts help us do that and stick to our process. So this question about valuations, we've used this slide previously, and the message of this slide is investors pay for earnings, and sometimes they pay too much for earnings. This is in the late 90s. You'll see the earnings line in red here, the market well ahead of that. That's what a bubble would look like. Since that time, we've been tracking the earnings line very faithfully, and we did have the flat market we were in for 18 months was really driven, we think, by flat earnings, and we discussed that last quarter as it related to the energy sector. Notice that the big jump in earnings from 2016 to 2017 represents about a 13% increase, and the early 2018 numbers that we're getting are showing a similar increase of around 12%. And even if those end up being a little bit optimistic, even 8 or 9 would still be very positive for stocks. And so the bottom line here is if the earnings estimates are real, and if investors continue to pay for them, then we do think the market could head higher. And this is in spite of the election, in spite of the news items. There are times when the news trumps earnings, but in the long run, earnings trumps the news, and that's the story behind this chart.
The other key thing I'd mention on that relates to our next slides is one of the other headwinds. There was energy earnings that were being reported, but also a continually strengthening dollar was pushing hard against earnings for any company that had business overseas. And as the dollar got stronger, their earnings became compressed, and there was one quarter where over 60% of S&P 500 companies reported that the strong dollar was a headwind to their earnings. And so we're relieving some of those headwinds now, and that's how we get to that 13% earnings expectation.
The other concern has been interest rates and what the Fed is going to do. And we found this cartoon. It seems like every time there's a Fed meeting, we get another, well, just a whole lot of press. And I thought this sign kind of carried that pretty nicely. And the interesting thing to us is when we look at the history of initial rate hikes, this goes back to 1983, you can see that every time the Fed increased rates, the market actually, there might have been a little jitters at the time that happened, but the market actually responded favorably to that rate increase. And if you think about it logically, the Fed is only going to increase rates if they think the economy is doing better. If the economy is doing better, that means the markets are doing better. And here's the quarter-point increase that we had a few months ago, and so far they've kind of kept it idle. Time will tell as to what the next steps will be. We don't pretend to be prophets here. The biblical penalty for prophecy gone wrong is death by stoning. So we don't know what the Fed's going to do, but we will continue to watch it. Just know that from history's point of view, an increase in the Fed funds rate has actually been a positive thing for stocks. Time will tell.
So that brings us to everyone's favorite topic of the day, which is the election. And I'd like to start off by saying that John and I have our own political opinions, as do the rest of our investment committee, but you do not pay us for that. You pay us to look at history and make good decisions and help you make good decisions with your money. One of the pastors at our church always said, you know, I'm not here to give my political opinion. If you want that, we'll go to lunch and you can buy. So I think that policy applies to us as well. And the other key thing I want to point out is that you and I aren't the only ones that know there's an election, and we're not the only ones that see the polls. The market, if you want to call it that, people who set the prices by buying and selling stocks every day, everyone knows there's an election, and the key point is that prices reflect the fact that there is this crazy election going on right now. So it's all, to a sense, it's priced into the market, and if it was such a bad thing, then stocks certainly wouldn't be up at the levels they are this year. So two key concepts that we wanted to carry into this conversation. The first is that while we're very concerned about, a lot of people are very concerned about what the election will do to the markets, what we have found in history is actually the markets may give us more indicator of what's going to happen with the election. And so what we see in this slide here is that historically, when the markets are up about this time of the year, leading into an election, the incumbent party will typically win that election. And if you step back and think about that logically, it kind of makes sense. People don't want to rock the boat or change parties of leadership if things are perceived as going well. And certainly right now we've made a pretty good case, I think, with the economic data that we've shared in this call, that economic data is on a good trend, employment's on the right track, there's a lot of positive things happening. So maybe we won't see a lot of changes in policy and parties here. And so I thought that was interesting. And there are studies that show under certain parties which markets perform well. John and I have looked at those, and they're just not statistically significant and not worthy to make investment decisions based on which party is in power. So again, the market and the economy is probably more likely going to dictate who wins rather than whoever wins is going to dictate what happens with the economy. Okay. Now, certainly the candidates aren't going to say that. So one thing we brought this quarter, last quarter we talked about things that we see as being relevant topics as we go into this election and go into new leadership. And last quarter we talked about the idea of perceived income and net worth inequality, and we also talked about the perceived importance of corporate tax reform. This quarter we thought we'd bring up a new topic, and that's the issue of debt. And the reason we want to bring up debt is not to make a big political statement, but just to point out the relationship between debt and GDP growth. And the relationship is when debt is high, GDP growth begins to slow. And what we can see here is, compared to historical standards, our debt levels are high. And primarily that is government debt. And when debt is high, nominal GDP is low. Real GDP is basically GDP minus inflation. And you can see real GDP when inflation or when debt is high is only about 1.5%, which is good to be in positive growth, but that's certainly not robust growth. As debt goes down, GDP tends to increase. And so I think that's a key topic here. And what this chart does not show is that there is an anticipation that around 2018 or so, we will see a significant increase in the rate that we accumulate debt in this country because of costs associated with Social Security and Medicare. And so there are big issues here that need to be addressed if we're going to keep a growing economy. And so whoever's in leadership and whatever's happening in Washington, that's one issue we think is going to be important to follow and will need to be addressed at some point, is how do we manage this debt and keep it more in control for the good of the overall economy. Now in the same blog post where I pulled this data from just last week, there was more of a silver lining and a positive happening here, and that has to do with just consumer debt and how the average American household is managing their balance sheet. And what you can see here in this chart, we had a similar chart in this in past years where we look at this debt service ratio, basically how much of people's income is going to service their debt. And if you look at this, we have really deleveraged since the 2007 peak in the housing bubble there. We've really deleveraged and it stayed down, meaning that homes, basically the average household, the average American, has cleaned up their balance sheet in a meaningful way. And this means a few things. It means that we have more monthly cash flow because we're not making debt payments, so we can spend a little bit more as well. But also, if we decide to take a little more debt, we can do so without putting ourselves back in another credit crisis. And what you can see, the result of that is when household debt is low, GDP is better. So we're down here in this below 10% range, and you can see real GDP tends to be quite positive in that range. So we have two competing factors here. Government debt is high, and that's bad for GDP, but personal debt is low, and that's good for GDP. So somewhere in the middle is probably where we are right now. However, if trends continue, the government side will be so negative it could have an overriding effect on the overall GDP growth. So again, something that needs to be addressed and something that we would hope would become more part of the conversation in politics in the coming years. So.
But we don't expect it to be till we get closer to a crisis. That's just the way politicians work.
So as we wrap up, we wanted to share a few key deadlines. We're going into the fourth quarter here and looking at year end. Before you know it, the holidays are on us, and we'll have Thanksgiving and Christmas, and everything will need to be wrapped up for the year. So the first one we wanted to share that's obviously on a lot of people's minds is Election Day. And the reason we point that out is, again, you don't pay us for our political opinions, and we're not going to tell you how to vote, but we think it's important that people participate. And we've been hearing a lot of whispers from people about staying home on that big Tuesday and just not participating in voting. And I can understand how someone might be upset about this election cycle, especially with the presidential election. However, keep in mind there's a lot of important things on the ballots, whether it's bond measures or we know in Arizona there's some big measures being voted upon with minimum wage and legalization of marijuana. All kinds of things are out there. So even if you're not feeling very passionate about one of our presidential candidates, maybe you need to get in and be involved with other issues in government. So please go out and vote, participate, encourage friends and family to do the same, and so we have a good participation rate on November 8th. As far as our business and what our ability to serve you, there's a few dates we wanted to make sure we point out. The first is there on December 2nd. If you're looking to do a conversion of an IRA to a Roth IRA this year, something we talk about with many of you, December 2nd is the deadline to do so. That gives Raymond James the ability to report that properly and have it become a 2016 event. Very important. For those of you who would like to make charitable gifts using your investments, we talk a lot about giving appreciated assets. If you want to do that with a mutual fund, we want those requests in by December 15th. Mutual funds are a little bit more complex to gift than stocks. Doesn't mean you shouldn't do it, but we just need to get started a little bit earlier. If you're working with the National Christian Foundation, many of you make gifts through the NCF. December 15 is also their deadline. They get a lot of year-end giving, and they don't want you running up against the end of the year. If you want a 2016 deduction, December 15th is the date. For stock-based gifts going from your Raymond James account directly to a qualified charity, December 21st is the deadline, and Greg Hartenbauer is taking over a lot of that gifting, but several of our team members are standing by to help you make those gifts. So definitely start thinking about those now. Let's get them in by mid-December. If you have a cost basis update, basically if you have a stock that either we're going to sell later in the year or you already sold and we don't have cost basis on file, let's get that in by December 22nd. That's important because if you don't have cost basis on file and we sell a stock, your 1099 comes in blank and we get a call from your CPA, and we don't like getting those calls. So we want to make sure that you're in good compliance there. And then last but certainly not least, if you are over 70 and a half and you need to make a required distribution from your IRA. We want those requests in by December 29th, preferably sooner, but that's the deadline. And if you do not take a withdrawal in time for those required distributions from your IRA, the penalty is 50%, 50%. So we definitely want to avoid that penalty. Our client service team is already looking at required distributions and who has not taken them. So if you haven't taken your required distribution, you will be getting a call from someone on our team with how much you need to take, and they'll assist you with making that distribution, so you're not facing a penalty at the end of the year.
There's a Texas word called used to could. We used to could go to the IRS and maybe appeal that 50% penalty, but it has been around now for such a long time. They're not very responsive to those appeals, so please don't miss that deadline. And sometimes the first year is a little bit confusing, so if you're 7.5 or just turned 7.5, feel free to pick up the phone and we'll go over the alternatives with you.
Yep, definitely. And we like to send those checks out in early November and let you do your Christmas shopping with it, so sooner is better. So a couple other key dates. I'm in the middle of leading a webinar series with 3 wonderful community experts here in Albuquerque on 3 different topics. We just completed a webinar with Glenda Durano last week. She's an expert in college planning. That presentation will be up on our website under johnmoore.com. On the top right, there's a media page where you can click there and look at recordings of webinars, including what we're recording right now for future reference. But we'll have that college planning webinar up there for those of you who are interested in that for children and grandchildren. Really great content that Glenda provided us. That will be up and live. That recording will be available probably on Friday of this week, maybe Monday next week. Tomorrow I'll be sitting with Dr. Linda Phelps from French Funerals and Cremations, also a leader in the newly formed Grief Resource Center here in Albuquerque, where John serves as a board member. And she'll be talking about grief and counseling and for people who are going through times of loss. I just sat down with her this afternoon, did a test run on the presentation, and her content is absolutely wonderful. So I encourage you, if that's something that you know somebody who's going through a situation like that and you want to know more about how to help that person, or if that's you who's going through a time of grief, it's an absolutely wonderful presentation she's prepared. That'll be tomorrow at 1 o'clock Mountain Time. And then third, certainly not least, we have next week on Thursday at 1 o'clock Mountain Time, we have Susan Stewart joining us from Decisions in Care. Her company, Decisions in Care, provides assistance with people making health care decisions for loved ones, family members, whether it's a spouse or a parent who maybe is going through a situation, maybe it's a rehab situation or long-term care. She's a great resource and helps people understand what's available to them and how to structure that. And she'll be providing a lot of valuable information during that presentation. So if you want information on how to log into any of these, feel free to shoot us an email. It's a very simple process. There'll be a webinar format just like today.
Yeah. And if this may not be something you need right now, but the resources will be available on an ongoing basis. So if you get to that point, you just go to that johnmoore.com/media and you'll find those there. So the other thing we wanted to mention is our annual Investor Education Day is actually going to be the 20th anniversary of John Moore & Associates. And the official date is March 7th of '97 when we started the company. We're going to celebrate on February 11th, and we're very excited about the venue at the Sandia Golf Club. The event center there is, I think, the best venue in the city at this point, and it's just a beautiful setting. We'll be getting more information out to you, but go ahead and mark that on your calendar. If you're out of town, we will have a block of rooms at the Sandia Resort available, and that's an easy walk to the golf club and the event center. Our guest speaker, our keynote speaker, will be Fritz Meyer. Fritz has spoken for us 2 times before, very entertaining, very educational, and we've had a lot of positive feedback and requests to have Fritz back, and we're excited that he's agreed to join us on that program. Again, be looking for information on this, and we would love to have you come celebrate with us this 20th anniversary.
So with that, let me double check and see if we have any questions trickle in during the presentation. And if you have a question, please punch it into the menu there. If you, again, click on the control panel on the right side, you'll see an area where you can insert questions. There's also a chat box. We'll keep an eye there for questions. If we don't see any coming through here, we'll be signing off. Looks like nothing's come through yet. So again, if something comes to mind either now or in the coming months, feel free to shoot us an email, a phone call, and we'd be happy to respond with a meeting or a phone call, whatever is appropriate. And we always look forward to speaking with you. It's always our pleasure.
Thank you again, and we hope you enjoy your evening.